Hey guys, welcome back to my channel. If you're new to the channel, my name is Humphrey and I make videos here on YouTube on personal finance and entrepreneurship. Last week I did a really quick analysis on if it was time to buy Apple after their most recent stock split, and today I just wanted to do the same thing but for Tesla since it was so highly requested among all of you after you guys saw my last video. So Tesla is basically trading at an all-time high right now, and so is the market, even despite the coronavirus concerns that we had back in March. And with Tesla being such a hot stock right now, that begs the question, is it even worth it to buy in right now? Are we at the top of the market? Should we wait for it to go down a little bit? Let's find out. The 5-to-1 stock split that Tesla announced back last month actually occurred today, so the price of a share of one Tesla right now is about $440. In today's video, just much like Apple's video last week, we're going to go over a few key points. The first being, how does a stock split actually work in the case of Tesla with a 5-to-1 stock split? Second, we're going to go through exactly what happens to a stock's share price after the stock has split historically. We're then going to briefly go over their last earnings report, and then I'm going to present to you guys a bearish case and a bullish case for Tesla, and then lastly, we're going to answer the question, should you buy Tesla stock or not? First, let's talk about their stock split. Earlier this month, Tesla announced a 5-for-1 stock split. For each share of Tesla that you owned before the split, you now own 5 shares of it. In my previous video on Apple, I used the analogy of a pizza being cut into 4 slices to explain a stock split for their 4-to-1 stock split. Well, in today's example, I have a really fun example for you guys. It's actually talking about pie, which is one of my favorite foods. I love apple pie, but sadly, the example that I found online, which has the best images for it, are just pumpkin pie slices. So hopefully you guys are okay with some pumpkin pie. So the split basically works like this. If you own a bakery and you sell pie, specifically pumpkin pie, and you're selling the whole pie for like $2,200, let's say, basically the share of a price of Tesla. That pumpkin pie on its own is sometimes a little bit too expensive for people to afford. So what does the bakery do instead? They cut the pie into 5 separate pieces. By cutting the pie into 5 separate pieces, they're able to sell each individual slice of the pie for much cheaper. The total price of the pie remains the same, but now there are 5 slices of pie that you could sell individually, and each of those shares would be a fifth of the total price of the original pie. This just makes it easier to afford for someone who can only afford, let's say, 1 slice of a pie. At least they get to still get in on the action. So that's exactly what happened today. The price of 1 share of Tesla is a fifth of what it was last week. However, there are 5 times as many more shares out in the market now. So do stocks actually go up after they stock split? Now, this is a fairly interesting question because when you have a stock split, it's merely just a cosmetic activity. So really nothing has changed with the fundamentals of the company. Just like my example before, just because you cut that pie into 5 different slices doesn't change the full value of the whole pie. Similarly, it doesn't change the value of the bakery itself. The bakery is still the same. They just basically cut 1 pie into 5 slices so people could buy it. Now, in my research to answer, do stock splits actually affect the share price? I found a 49-page research paper by Columbia University conducted back in 2012 where they analyzed a bunch of companies that underwent a stock split. What they actually found was really interesting. They found that analysts tend to increase their earnings estimate around stock split announcements. They also found that the future earnings growth of the splitting firms is higher than that of the matched firms with similar past earnings growth for up to 2 years following the split. Now, this doesn't happen all the time, but it does seem that stock splits have some sort of influence on human biases, putting more attention into the stock itself and actually increasing its share price over time. This could be due to many reasons, but some of the reasons that I think this actually happens is that the first reason is that stock splits actually draw a bunch of press coverage. Now, I talked about this in my last video, but basically when a stock has more press coverage, guess what? More people are going to be interested in it, and as a result, more people are going to probably buy that stock. Number 2, the reduced share price actually makes it more attractive to many more investors. Even though we have things like fractional shares on Robinhood, the majority of people are still not trading on Robinhood or a platform with fractional shares. The psychological effect is actually pretty interesting here. It's almost like, okay, they could have afforded 0.2 shares of Tesla before, but now they can afford 1 full share with the post-split price. Nothing's actually changed here, guys. The $440 price point just might be a little bit more palatable to someone who only has, let's say, $500 in their portfolio. And the third reason why I think stock splits tend to drive the price up is that it usually coincides with a good earnings report. So let's actually discuss quickly what Tesla's last earnings report was and how it could be a driver for the stock price moving forward. The biggest news that Tesla actually reported in their last earnings report was that they were profitable for the 4th straight quarter. quarter. The reason why this is so significant is now that they're eligible to be included in the S&P 500 index because the requirement is to at least maintain profitability for at least a year. Now, they still have a long way to go before they get actually included in the S&P 500. I believe a committee has to agree on their inclusion. But if they were to be included in the S&P 500, that means all the large institutions that have index funds basically will have to buy Tesla or be forced to buy Tesla to continue to include all of the stocks in the S&P 500 index fund that they might have. Another interesting note of the earnings report is that Tesla is now building another factory in Austin to start rolling out semi-trucks and Cybertrucks. That factory will also be responsible for increased production of Model 3s and Model Ys. Lastly, their revenues in their last earnings report was $6 billion revenue versus $5.37 billion expected, as well as a net income of $104 million and better than expected delivery results of all their vehicles. So it's clear that Tesla had a really profitable quarter despite coronavirus concerns, but that still doesn't answer our question, is the price justified? I'm going to outline a bearish case for you guys, and then we'll outline a really quick bullish case for Tesla. For a bearish case, one of the top articles right now on Seeking Alpha is by a man named David Traynor, and he writes a few thousand words about why he's bearish on Tesla. It's well worth the read, and I'm going to link the article in the description below so that you can check it out if you want. But he sums up the bearish argument quite well, and the first reason that he cites for being a bear of Tesla is that there seems to be a large disconnect in their future cash flows and what currently Tesla is valued at right now. That's not to discredit Tesla, but basically there's too much credit being given in Tesla's future cash flows. One of the metrics that we can look at is market capitalization per vehicle sold, which basically just takes the market cap of the current automotive company and divides it by how many cars they're selling. In the case of Toyota, they have one of the highest, and it's 19.7K per car sold. Now compare that to Tesla. Their market cap value per car sold is a whopping $880,000. Now the idea here is that that's over 44 times what Toyota is basically at right now. Tesla also owns less than 1% of all automotive market share across the world. Toyota has 12%. And the argument here is that how can there be even more upside from here? The second argument that bears are going to make is that other automotive makers, including Volkswagen, Ford, General Motors, and stuff like that, they're going to start to enter the electric vehicle market and start to take some of the market share away from Tesla by the time it's 2025 or 2030. Tesla plans to sell about 500K to 600K cars in 2020 and 2021, but the idea here is that the automotive makers, the big ones like Volkswagen, are going to start pumping up their electric vehicle production, and by the time it's 2025, their actual numbers are going to be expected between 332,000 to 1.5 million electric vehicles per year. So think of Toyota, GM, Ford, and Volkswagen as really large cruise ships, but once they kind of set their course and direction, then they're going to start going full speed ahead. It might take them a long time to shift directions, but once they do finally shift directions, they're going to try to hit it as hard as possible. So that's the second reason bears are going to just cite increased competition across all automotive makers. The third reason why bears don't like Tesla is that part of their Q2 profits were mostly from regulatory credits. As you may know earlier, I said that Tesla made a profit in Q2, but actually some of that profit was actually derived from the regulatory credits they were able to sell to gasoline automakers. Tesla receives these credits due to them being an all-electric vehicle maker. Now, bears will say that they did this to report 4 straight quarters of profit so that they could have the option to be included in the S&P 500, essentially saying that you cannot rely on these regulatory credits for profitability in the long term. The fourth reason that bears are going to cite is that battery technology is rapidly evolving, and thus Tesla's battery competitive advantage in the space is going to fade away slowly. GM just announced a new battery that has 400 miles of range for about $120 per kilowatt hour. Compare that to the industry average of $164 per kilowatt hour. So the increase in these batteries from other automotive makers is slowly going to eat into Tesla's competitive advantage with batteries, and that's the fourth reason that bears are citing that they don't like Tesla. One last reason that the bears are going to cite with Tesla is that simply that the math doesn't make sense, and this is kind of a continuation of point number one. And this is based on the idea if they have a 7% net profit margin, which is equal to Toyota, and their revenues are expected to increase 26% year over year, while using a reverse discounted cash flow analysis, their price should actually be closer to $813 per share. And that was the pre-split price, so the post-split price of that is just divided by 5, so about $162.60 per share is what they should be valued at today using a reverse discounted cash flow analysis. What I'll do is I'll link to that DCF model in the description below so that you can check it out after this video. Okay, so now let's talk about the bullish case. I think there are a lot of great reasons to own Tesla. I'm trying to stay as neutral as possible in this presentation so that you can decide for yourself, but let's hear what the bulls have to say. The bulls are all about what Tesla is going to do in the future, and that starts with number one, Elon Musk. If you invest in Tesla, you're basically betting that Elon Musk is going to stay relevant and going to be a huge factor in human civilization for the years to come. I mean, he basically shaped this electric vehicle wave in the past 10 years, and it's only going to continue growing from here. You're also investing in him knowing that he'll probably diversify the product offering that Tesla has. Tesla cars are already the best-selling electric vehicles in North America with about 225K in unit sales this year. And as they introduce new models and new offerings, we can only see this market share growing. They're also going to start introducing products like the semi-truck and the Cybertruck. So if they continue to keep up pace with their innovation and their product design, they're basically going to come out with new products all the time, and that is one of the bullish cases for Tesla. Second, as mentioned earlier, if they do get included into the S&P 500, a lot of these large institutions are going to have to buy Tesla stock and sell existing stock in other shares. And how much are they going to have to sell? About $40 billion worth, and buy Tesla instead. So that should drive the price up. The third reason that bulls are going to cite is that coronavirus actually impacted production numbers earlier this year, but demand remains very strong for the product. So assuming that coronavirus slowly fades over time over the next 3-4 years, the demand for Tesla products is still going to be there, so the supply will slowly have to match the demand and subsequently increase the number of units being sold, profit being generated, and revenue being generated. The idea here is that contrary to the bearish case, they actually own such a small percentage of the automotive market share that there's a lot of room to grow. So the total addressable market for Tesla is actually quite large. The TAM, if you will, is a large opportunity for Tesla to pursue. The fourth reason that bulls are going to be really bullish on is that they've overcome a lot of bear arguments in the past. Some of these arguments include, but are not limited to, first of all, Tesla making only high-priced cars. That's actually not the case. Tesla has introduced the Model 3 and the Model Y to be price competitive. The second argument bears used to state was that you can't make those electric vehicles profitably. Well, we know that that's not the case anymore. Tesla is now a profitable company. The third argument that bears used to tout was basically, hey, there's not going to be enough demand for electric vehicles, but we can see that's definitely not the case. And the fifth reason to be bullish on Tesla is that Tesla seems more than just a car company. They have dealings in energy and dealings in autonomy. They also seem like kind of a data company to me. I mean, they get all the data from their self-driving vehicles out there, and they're able to make some conclusions from this data to even help lower car insurance payments. So with that all being said, should you buy Tesla stock? This is a tough question because most analysts rate Tesla as a neutral right now, so it's neither a buy or a sell. But really what it comes down to is if you believe Tesla is going to continue to grow in the long term, and if you don't think they're too overvalued right now. It is hard to say that it's not overvalued though. I mean, this year alone, Tesla shares have gained 430%. Meanwhile, the S&P 500 has only gained about 8.58%. That doesn't seem normal to me. I don't know if it seems normal to you, but that's definitely up to you to decide. So if you have a strong belief in Tesla, if they're going to keep continuing to grow their product, diversify their product, and you believe in Elon Musk, or maybe you just like their products or believe in the EV future, then it may be a good time to hold on to your Tesla shares or even add to your position. If after everything presented today, you want to hold Tesla in your portfolio for the next 10, 20, 30 years, I don't think it's such a bad thing to have in your portfolio. However, I will personally say that I think it is overvalued, and it does seem like a really, really hot stock right now that the internet is paying attention to. So it seems like a meme stock more than anything. And it feels like a lot of people are just trading on it because they don't want to miss out. If you watched my last video, we still don't know what's going to happen to the economy. We know that the economy is not equal to the stock market and vice versa. The fact that the S&P 500 is close to its all-time high, despite unemployment being close to 10%, still boggles my mind. So just because the market is up this year, we still have a lot of underlying problems in the United States, including the economy. And those problems just might not have caught up with us quite yet. Also, there's the looming election that's going to come up in about a few months that might actually increase volatility in the market. So if you're a bear and you think that the market is going to reflect the poor economy soon, or if you think the price of Tesla can't be justified by their financials, it may just be a stock to stay away from or just to sell after you've booked a solid return. So I hope that this video was helpful for you guys. I know it's just a really broad and general overview of Tesla, but hopefully some of that information helped you out. If you enjoyed this video, please click the like button on this video, subscribe to my channel if you haven't already, and tick the notification bell because I make videos here on YouTube twice a week. Let me know in the comments if you're buying, holding or selling Tesla stock. I love reading and replying to all your comments. And also let me know if you'd like to see more quick dive analysis type things like this on different stocks or personal finance concepts. Also, feel free to follow me on Instagram. I post something there pretty much daily, so if you'd like to be a part of it there, that's where you can find me. Lastly, if you'd like a free stock from Robinhood, use my link in the description below, and the stock could actually be valued up to $200. Okay, that's it for now, guys. I hope that you had a great time, and I hope to see you guys in the next video. Peace.